very strong ADP report. Now, this is not the official jobs report, but it is the private jobs report that we like to use as sort of a tool for saying, hey, is the public report being honest with us, or are we getting tricked? Well, let's just say $278,000, pretty dang hot. This is very similar to almost the JOLTS data that we saw yesterday, suggesting, hey, if you think the economy's slowing down, hold your horses. There might be parts of the economy that seem to be slowing down. As we know that the freight economy is in a recession. We know that Macy's just reported a slowdown in guidance for the rest of the year. They actually had a pretty good earnings report overall, but they did report a slowdown, and that slowdown led them to drop another 10%. Now, to some extent, that might not be a terrible surprise. A lot of people were fleeing to Macy's during the pandemic, and this idea that retail stores could keep this boom going, maybe not something that was realistic. Although Nordstrom's still doing pretty well, so some differences. But this hiring, some folks say, is seasonal for travel for the summer. Some folks say, look, this is just a company by company difference, and you don't have to be terribly worried about what's going on with the overall economy. And if you just look at the jobs data, kind of reiterates that. Now, what we'll do is we'll go through the actual ADP report, but what I'd also like to do is reiterate some of the things that are going on with the Federal Reserve and expectations for the Fed, because we just hit the lowest level of the 5-year break-even expectations at the same time as getting this ADP jobs report, which is odd. We would think that, wait a minute, how are we continuing to see inflation expectations plummet the way they are? And no matter which way you slice it, the reality is inflation expectations are plummeting. Inflation expectations now down on the 5-year break even at 2.09%. Now, this is the first time I've been able to say 2.0 for, basically 14 months. And my belief is that once that 5-year break even falls to about 1.6, that's when we're going to end up getting interest rate cuts. Now, again, I want to go through this ADP jobs report, but first, I think it's going to be quite interesting to look at this 5-year break even, and then we'll go through the details of the ADP report. So I'll put the 5-year break even up on screen here. It'll just take me a second. Let's see, share screen. I just need to click window, and it's going to be this one. There it is. Okay, look at this 5-year break even. So this is the actual 5-year chart of it. This is the 1-year chart of it. What's remarkable at that 1-year chart is, look at that, 2.0942 as of just the last seconds here as I took a peek at this. This is incredibly low, the lowest level finally that we've ever had. Here, this chart showing you the last 12 months. And then, of course, if we look at the last 5 years, you can see we are still higher than where we were after the pandemic. Here's your pandemic low. Sort of on the left side here. And before the pandemic, the last time we cut before the pandemic would have been over here in December 2018. And you can see that level was sitting right around 1.6 when we last cut. Last cut was roughly here, November, December period here in 2018. And or at least the Fed had some form of a pivot, right? And so we're still ways to go from there, but clearly on the right trend, which is fantastic. So now let's take a peek at the ADP jobs report. I do want to always start with inflation data when it comes out, though, and this is great on the 5-year break-even POV, and it somewhat aligns that once we get to that 1.6 level, Fed could be in a pretty decent position to actually cut. But we're not there yet. So what do we have here? So this is the ADP employment report. Annual pay was up 6.5%. This is probably the most important segment, in my opinion, to look at, is that annual pay section. What we don't want to see is a runaway of this median change in annual pay. We want to see this stable, right? Stable, or maybe potentially rising at a reasonable level. Somewhere between 3 to 4% is generally what's deemed consistent with 2% inflation. So you don't actually need 2% wage growth to have 2% inflation. The last time Jerome Powell touched on it, he recommended a 3% wage gain. So obviously, seeing wages rise 6.5% is still relatively strong. You see that for job stayers, the increase was 6.5%. That's down from 6.7% in May. And for job changers, that gain was 12.1%, down a full percentage point from April. That's actually fantastic. So you're seeing a good slowdown here. You're still seeing wage gains, which is good for employees. Every time I mention this, people are like, "Oh, Kevin, what, you don't want people to make more money?" No, that's not what I'm saying. What I'm saying is we don't want this to run at an unsustainable level, because then it'll ultimately be worse for everyone in the economy. So this is good. This is consistent with this decline in inflation, potentially consistent with a pause as well. Now, I'd like to see where these jobs are coming from, because this is 100,000 jobs over expectations. And we also had a slight revision in the previous report, but only by about 5,000 jobs. So it doesn't matter too terribly much. What matters here is that we beat by about 100,000. And so what do we have? Well, we have manufacturing that came in at negative 48. Some folks suggest, yeah, well, we are in a manufacturing recession. If you look at the Chicago manufacturing, some of the leading indicators, at least in the Chicago region, this is very consistent with a weakening in manufacturing. It could just entirely be related to people buying less stuff. Natural resources, mining, construction doing very well, actually quite well here. You can see mining up 94,000, construction up 64,000. Then we get to service providing, and look at that leisure and hospitality boom. 200,000 job gains in leisure and hospitality. Education seeing a decline of 29,000. We are going into the summer, though that is bundled up with health services. Financial activities, probably your investment bankers, mergers and acquisitions, and otherwise, a lot of actually what happens here in New York. A negative 35,000, IT negative 15,000. And we're still, at least based on some anecdotal interviews that I'm doing with individuals in in the IT space, we're not seeing companies that have started with layoffs actually return to hiring again. And I think that inflection point will be quite important. I was hoping that maybe artificial intelligence would lead to an initial inflection where we would start seeing a return to maybe some hiring again. I know that sounds wild. Some people are like, Kevin, why with AI would companies be hiring more? And I'll explain that in a moment. But we have not started to see any of that inflection, at least based on what we're seeing in not only these reports, given that information is still here negative at 15,000, but also just anecdotally in talking to individuals working for various different tech companies. And why this is important, or why I believe there could be more hiring because of AI, is strictly because of the belief that companies don't want to be left behind. So I have this belief that companies will recognize this AI boom and make more investments to make sure they don't fall behind, and that they can preserve their moat for as long as possible. I do believe that artificial intelligence narrows down the moat of companies substantially, but by hiring people potentially within the AI space, maybe they could catch up. Now, there is another belief that people would simply just be repositioned within existing companies into AI teams. That would not lead to net new hiring. In fact, that would be consistent with potentially continued job loss in information and technology. And so, at least tentatively from this ADP report, that's what we're seeing. Now, remember, this is the private report. We do have the public report that comes out tomorrow. Tomorrow morning at 5:30 in the morning, we will see the official jobs report come out. Now, the official jobs report, just to give you a forecast before we continue going with this report here, the official jobs report tomorrow is looking at a 195,000 jobs report with 164 for private payrolls. Unemployment rate ticking actually up to 3.5% from 3.4%. If we get anything like the report that we just got in the ADP report, wow, we are, yeah, we're not going to be able to say we're really trending towards a recession anytime soon. The employment can really keep us out of a recession. So to some extent, this is a good thing for avoiding recession, especially if wages are low. Well, I shouldn't say wages are low. Wages are growing at a slower rate. That's the best way to phrase that. Now, We did just get productivity reads as well. We got non-farm productivity. We were expecting negative 2.4% for the first quarter. We actually got negative 2.1%, so a bit more productive than we were expecting. And here's another really good indicator. You ready for this one? Unit labor costs for the first quarter were expected to be 6% at an annualized year-over-year rate, and instead we got 4.2%. Very solid report. That's a solid report showing more strength, again, with less inflation. More strength, less inflation means no stagflation, no recession. That's good for now. Obviously, things could change. Again, we saw that with the Macy's earnings. We could get a complete flip flop. And I'll go through some of the numbers for Macy's in just a moment as well. But looking at initial jobless claims, we get initial jobless claims of 232,000. That was right along expectations of about 235,000, with continuing claims actually coming in slightly lower than expected, and the revisions relatively nominal. Okay, so continuing with the ADP report. Let's use the correct button here. Oh, by the way, today is June 1st. That means this evening we do have that price increase set to go into effect for the programs on building your wealth, as well as the uh, building your income with the productivity course and building your income course, which is how to make more money and get SH19 done faster. The AI lectures drop soon. We actually have that moved for the 6th of June. Some incredible quality lectures coming out for the artificial intelligence side. And then with that price increase for the final pre-sale ending tonight. So take a look at those. Link down below. So, okay, what are the regions where we're seeing some of this pain? Look at this. This is really incredible. Almost exclusively, we have a slowdown in the south, with some in the mountainous region of the west, but you have massive growth in the Pacific, the Midwest, and the Northeast. Now, that's actually very interesting. South Atlantic, East South Central, West South Central, complete losses over here. I wonder if this is a bit of a reversal of what you saw during the pandemic, where during the pandemic you saw people essentially move from New England or maybe California over to Texas and Florida, and now you're seeing somewhat of a reversal. This is actually going to have large real estate implications as well. So I'd like to pay attention to this from a real estate point of view. That, wait a minute, isn't this interesting that we are seeing this almost job creation in areas that weren't doing so well in the pandemic boom? And now in a post-pandemic area, the areas that were some of the biggest recipients of the pandemic boom are actually seeing some of the biggest weakness in job growth. That's something to pay attention to. Something else to pay attention to. Look at this. The hiring is almost actually, it has exclusively been among small enterprises and medium enterprises. With if you take out the larger of the medium-sized enterprises, you can see most of the hiring is actually at businesses between 1 and 249 employees, whereas 250 plus employees, barely any hiring, and your largest employers losing or shedding employees. Fascinating. All right. Pay gains we've reviewed. Here are some pay gains by industry. And we've seen this slowdown here now consistently continue, which again, it's a good thing. This is a good thing. We want people to make more money, yes, but we do not want this to accelerate at some unsustainable level. So again, we're comparing to the ADP report or the prior release of the ADP report. This is fantastic. So very good. Again, a stronger ADP report with less inflationary concerns, leading likely to this 5-year break even, slowing down to the lowest level that we've seen in, quite frankly, the last year. You would have to actually even more than that. You would to get this low of a 5-year break even. You have to go to January 2021. We are actually at the lowest level of inflation expectations for the market in almost 2.5 years. That's remarkable. At about 4 months to 2 years, 28 months or so. That's remarkable. Now, when you look at Macy's, It is worth, I think, looking at Macy's in context of the broader economy, though. Somebody asked me, it was a course member asked me in the course member live stream the other day, "Oh, what about Macy's?" And I said, "Yeah, well, I'm not a big fan of retail, but I'll say, anecdotally, I've been to a few Macy's with the family, and they always seemed a little slow here recently." It was just a total anecdotal comment, but it's interesting to see that line up with what some of the numbers were coming out of Macy's. Macy's gross margin actually improved a little bit to 40% on gross margin, which is incredible. And their earnings were actually better than expected, but it wasn't this quarter that people cared about. It was the rest of which is really, now in the past. It's the last quarter that they're reporting now. The current quarter and the forecast for the rest of the year were the red flag. In fact, Macy specifically cited macroeconomic impacts to the consumer, as well as markdowns to address excess inventory, spring inventory. Macy's fell as much as 12% in the pre market. Their forecast for the year on adjusted EPS was at a midpoint of about 295. They were expecting a midpoint of closer to about 380. That's almost a complete $1 reduction in EPS in their forecast for the year, and citing additional incremental clearance markdowns as well to get through some of the inventory they have. This is not an inflationary report once again. And again, I do believe that most of us are of the mindset now that, okay, we finally agree. Yes, inflation is finally going away. That doesn't mean prices are going down. It just means the rate of pricing growth has substantially slowed, and maybe they'll start going down, at least in specific industries. Retail might be one of those. And yes, the argument is that, hey, you realize, like, if you have negative inflation in certain industries, such as whether it's disinflation or just straight up deflation, and let's say retail or like freight, that could also lead to an earnings recession. This is true, but I think we have to segment out which industries might be going through that earnings recession in the future versus which have already gone through it. I think the argument can be made that the chip sector, for example, which is why I have a heavy allocation to it, uh, I can believe that you can make an argument the chip sector has already seen its earnings recession, which was really more of your June through January earnings recession. So we'll see. But this I find very, very interesting. This overall, I think this is actually a very good news set of data. We've got the Nasdaq presently down just 10 basis points in the pre-market, market opening in about 50 minutes. You've got the S&P down actually up 0.07, and the Dow down 15 basis points. Oil's basically flat on the day, and you've got the 10-year Treasury rotating down again to 3.62%. So overall and broadly, less inflationary fears, better results on the overall economy, likely consistent with the belief that the Federal Reserve will indeed pause. Yes, they're going to, make us be on our toes and make this argument that, well, even if we pause now, we might end up hiking again in July. I think it's bullcrap. In fact, after the Federal Reserve leaked this, leaked to the Wall Street Journal. I mean, some of them have been talking about it, but once you hear the leak in the Wall Street Journal, usually it's like, all right, that's what you need to start pricing in. As soon as that Nick T piece came out yesterday, guess what happened? The expectations for Fed rate hike flipped again. Remember how we were at basically a 2/3 expectation that we were going to get another rate hike? As soon as that article came out, the expectations flipped. We're back to 2/3 likelihood based on market pricing that we're going to pause. This is relatively consistent with the argument that Jerome Powell has made, and it's consistent with the belief that we're going to get our pause in June, which is great. That's in 2 weeks. And short of like some kind of really scary inflation report, this ADP report is not scary. It is consistent with a pause, which is fantastic news. Now, I would like to share this screen with you right here. No, it is not a reiteration that prices for the courses on building your wealth and making more money and the AI segment are going up tonight. So join them tonight. And if you need a bundle up, email us at staff@meetkevin.com. This instead is a graph that's known as the World Interest Rate Monitor. Now, I think it's a very interesting graph because it's also slightly complicated to understand. And I'm going to provide the simplest explanation for it. So, a simple explanation of this tool is basically saying that right here is the highest we expect interest rates to go. Now, the market does not have to be perfect with this. This terminal rate right here is actually slightly above the level of 5.25. Our current interest rates are actually at this level where I've created this box. That's where interest rates presently are. And you can see there's a little bit of the market that thinks we still have a chance of a July hike, just a little bit. That little bit of excess orange right there is the pricing in of a July hike. However, you could see right after July, we go straight down. We expect our first cut to start getting priced into the market right here. This is December. You can see the market. Well, I mean, I guess you can't see what the market previously priced in because I don't have that chart up, but the market previously priced in rate cuts as soon as September. That has now moved over where you see these rate cuts here. We're coming in December. The market is expecting us to be in that 4.95 range, which would be consistent with about one rate cut. And coming January, the market is pricing in about a 4.75 midpoint here, which would be consistent with about two rate cuts, which is fantastic. That would be great, and market seems to be anticipating this. And now the market does still believe that there's this chance of a recession in the second half. I personally believe with some of this hot jobs data we're getting, that the likelihood of a recession is probably going to be a lot closer to a Q1 of 2024 argument. We're going to start seeing economists kick the can down the road on this idea of a recession. And if they kick the can down the road, then what ultimately is likely to happen is we could avoid a recession entirely. So the further we go, the better. So I'm very excited about that. Now, I don't want to be overly optimistic. I want to be realistic with data. However, I do believe that we're being realistic based on just the data that we see coming in right now. I think it's safe to say that we are making a very clear argument for, well, ultimately, strong economy continuing for the rest of the year. Again, it's not going to be every segment, just like what we talked about with Macy's. It's not going to be every segment. But overall, I'm optimistic. And I think we have reason to believe that that optimism is somewhat justified.